Do we really think that the tech environment, which has changed beyond all recognition in the past 20 years, is going to not change in 20 years, so that the same Apples and Microsofts and Googles will be top of the pile in 20 years? I mean, that seems a sort of almost foolhardy assumption, and yet they can issue long dated bonds as easily as short dated ones. So I think basically investors don't really match up the risks to when those risks are going to occur, and I think therefore if investors do decide that oil and gas companies are too risky, they'll just move out of all of their bonds, not just the long dated ones.
Does that therefore mean that the market is ignoring the risk of these companies altogether?
No, I don't think it is. The market is pricing oil and gas companies' bonds wider than ordinary bonds, in Europe at least. We've looked at some research by ABN AMRO, which shows that over the past 3 years, apart from a couple of periods, for example, COVID and the extreme energy price rises last year, in the euro bond market, oil and gas companies have traded about 3 to 8 basis points wider per year of the bond's duration than corporate bonds in general. So that means for a bond with a 10-year duration, if the gap is 3 basis points, that would be 30 basis points on a 10-year bond. So it's quite a significant gap. And that's despite the fact that the oil and gas companies are actually better rated on average. Their average rating is A3, which is a notch higher than the corporate bond market in general. But in the dollar bond market, you can't see a difference, really. They effectively trade like other corporate bonds. And that makes sense when you consider that ESG investing is much more widely practiced in Europe.
I mean, the thing is, look, if oil and gas bonds trade just a few basis points wider than the average for corporate bonds, even in the long maturities, it's not really the same thing as the market pricing in the risk of oil and gas having to be phased out, really, is it?
No, it certainly isn't. And I think this means that fundamentally the market is not pricing in that risk. And unfortunately, the collective intelligence of the bond market does not expect the transition to low carbon to happen fast enough for us to avoid, what we know are going to be very severe impacts of climate change. And I think this is one for people to think about who believe in the efficient markets hypothesis, which does not include me. But there's an inherent illogicality in this, given that the market may be right that we're not going to transition fast to low carbon, but in that case we are going to have very severe physical impacts from climate change, and the market certainly isn't pricing those in properly either. So I think the worrying signal from these bond prices effectively is that investors are not properly pricing in a good scenario for the climate.
So to go back to the original question, how should investors assess and mitigate the risks of investing in oil and gas and coal bonds?
Well, I suppose from a basic profit maximizing point of view, there probably is money to be made from holding oil and gas bonds, but you want to be able to get out quickly. And as everybody knows, being sure of being able to get out of an investment quickly is always difficult. Everybody else might be trying to get out at the same time. So I suppose that might imply you would want to own shorter bonds. So at least they might mature. But it's very important to say, I think, that oil and gas bonds are not the only ones that carry transition risk. They are supplying the oil and gas to the economy, but everybody else is using it and consuming it. So we're just as much sort of addicted to oil and gas as they are. And investors should be thinking about how climate and other environmental and social risks affect every bond, and looking really for the ones that are aggressively cutting their emissions, so reducing their that addiction, and also those that will profit from the transition because they're part of the solution.